Welcome back to the show. Today, I want to start with a single statistic from Cape Coral, Florida, that I genuinely could not stop thinking about all week. Roughly 70% of the people who bought a home in Cape Coral in the last 2 years using a government backed loan are currently underwater. 70%. They owe more on their mortgages than their houses could sell for today. That is not a rounding error, that's a signal, because the government safety net that has quietly propped up global housing for 2 decades is being ripped away right now, right under our feet. And most people don't yet realize the rules have changed. So today we're pulling from a really dense stack of sources: real estate and foreclosure data hubs, international budget documents, including Australia's 2026 to 2027 budget, macroeconomic analysis, and health policy research on the senior living sector, which is going to end up being a fascinating angle we didn't expect to hit. Our mission is to explore why governments, after decades of aggressively catching every falling housing market, are suddenly just letting gravity do its job. We're going to figure out the mechanics of this shift, dispel the fear-mongering flooding the headlines, and identify exactly who is going to foot the bill. Because someone always does. Someone always pays. Before we jump in, a quick disclaimer: this is general economic analysis, not investment advice. Also, if this kind of analysis is what you come here for, the best way to make sure you don't miss the next one is to subscribe. Takes a second, means a lot. Now, back to it. For 20 years, the unwritten rule of the global economy was that housing was simply too big to fail. If prices even threatened to slip, governments worldwide immediately stepped in with subsidies, tax breaks, or new lending schemes just to prop those prices back up. Just throw money at it and stabilize. But the global data from 2026 is showing us a very different mechanical reality. The rule is breaking. Let's get into it. For 2 decades, the assumption was that any housing drop would trigger an economic crisis. So governments kept intervening. And they gave us policies that were supposedly meant to make housing more affordable: 1% down payments, letting people tap into their retirement funds early. Sounds helpful on paper, but mechanically, those were just demand-side subsidies. They didn't build a single new house. It's like trying to fix a coffee shortage by giving everyone bigger mugs and more money to spend at the cafe. You haven't created more coffee. You've just given desperate buyers the ability to bid slightly more, which ironically drives the price of a cup through the roof. That is asset inflation dressed up as affordability policy. And now, the research shows the rule is breaking. Governments are actively pulling the plug on those demand subsidies at a massive global scale. Take Australia's 2026 to 2027 budget. Australia has historically had some of the most overheated residential real estate on the planet, heavily subsidized by a tax policy called negative gearing. Mechanically, that policy allowed investors to write off the losses from their rental properties against their regular day job salary, which sounds arcane, but it heavily incentivized buying homes at a loss just for the tax break, which of course bid up prices everywhere. Well, the new budget phases out negative gearing for established homes starting in July 2027 and reforms their capital gains tax discount. They are actively disincentivizing the treatment of existing housing as a purely speculative asset. That is a huge structural shift. Over in China, authorities have maintained strict financing regulations on property developers, starving them of the easy credit they use to inflate their massive property bubble in the first place. And in one major economy that many of you are probably familiar with, we've seen a policy package that uses grants to encourage local governments to reform restrictive zoning rules and finally allow denser building duplexes, townhomes, apartment complexes. The same package has floated restrictions on the largest corporate buyers acquiring additional single-family homes. Notice what all three of these have in common. They actually address the supply side, and they signal a fundamental change in intent. The real question is no longer whether prices will fall with these structural shifts and the current elevated interest rate environment. Price adjustments are a mathematical certainty in many overinflated markets. That's just gravity. The real question is who pays for that drop when governments finally stop socializing the losses. Before you panic, I want to make a critical macroeconomic distinction that almost nobody in the headlines is making. We have to clearly separate a crisis causing falling prices from falling prices causing a crisis. Those are two completely different animals. Let me walk you through both. A healthy market correction happens when supply simply catches up to demand. Look at Denver. Denver heavily reformed its zoning laws a few years ago, made it much easier to build. Developers actually built housing units. Supply increased, prices dropped about 2%, and rents fell across the metro area. Renters upgraded their living situations. Households suddenly had more disposable income because less was going to landlords, and the broader regional economy actually grew because that money got spent at local businesses instead of paying rent. The price of the underlying asset fell, but society as a whole benefited from cheaper shelter because cheaper shelter frees up capital for the actual productive economy. Now contrast that with a real collapse. A collapse is when the underlying economy fails and drags real estate down with it. The classic example is Detroit. Decades of deindustrialization caused a massive population exodus. The jobs disappeared, so the people left. Demand vanished. House prices fell by roughly 80% to the point where literal houses were cheaper than used cars. But the key mechanism is this. The falling prices in Detroit didn't cause the economic ruin. They were a symptom of it. That distinction is everything. In a healthy correction driven by new supply, the underlying economy is perfectly fine. In a Detroit-style collapse, the economy was already broken. Here's what this means for you. When you read a headline about home prices dropping in a specific metro, the first question isn't how much. The first question is why. A 5% correction in a city that just approved dense new construction is a completely different signal than a 5% drop in a city whose main industry just packed up and left. But that distinction brings us to the ghost in the room, 2008. Whenever we talk about housing prices dropping, nobody thinks of Detroit or Denver. Everyone immediately flashes back to 2008 and the Great Recession. So if this is in 2008, why are the major real estate industry groups and financial headlines screaming that the sky is falling? Who actually benefits from generating all this panic? It's vital to understand the mechanics of what actually happened in 2008, because it was a financial system crisis that merely used housing as a convenient conduit. Housing was just a vehicle. Back then, Wall Street banks were taking hundreds of thousands of garbage, subprime mortgages, loans given to people with zero income verification, the famous ninja loans. No income, no job, no assets, bundling them together into complex securities, slapping AAA ratings on those toxic bundles, and selling them globally. This is what economists call securitization risk. So when the housing market wobbled and those bad loans defaulted, it blew a multi-trillion-dollar hole in the balance sheets of the world's biggest banks. It froze the entire global credit system, but the mechanics are completely different today. Lending standards have been incredibly strict for over a decade. You can't get a mortgage today by just signing a piece of paper and saying you have a job. Banks actually verify your income, your debt-to-income ratio, your credit history. The core rot that existed in 2008 just isn't there in the securitization market today. The banking system is largely insulated from a standard housing correction. The fear-mongering largely comes from industry lobbying groups, massive corporate landlords, and highly leveraged asset holders. They stand to lose. They want to protect their investment yields and maintain the government protections they've enjoyed for decades. Most regional housing corrections pass completely unnoticed by the broader national economy. If prices in one city drop 15% because that city built a ton of new apartment complexes, Wall Street doesn't collapse. But there are still legitimate economic dangers where falling prices become genuinely dangerous. Let me walk you through the three specific mechanical triggers to watch for. First is over-leverage at the consumer level. This is when people owe far more on the asset than they can handle, leaving them with no equity cushion to absorb a financial shock like a medical bill or a temporary layoff. They're stretched way too thin, and one bad month becomes a foreclosure. Second is housing functioning as collateral. This happens when the broader financial system, or even just local small businesses, rely heavily on inflated property values to back up other unrelated debts. Picture a small business owner taking out a huge commercial loan to expand their plumbing business using the inflated equity in their primary home as collateral. When local property values drop sharply, the bank notices the collateral is no longer sufficient. The bank might call the loan in or demand immediate cash, which forces the plumbing business to lay people off or even go bankrupt. The housing drop directly damages the productive economy. The third trigger is dependent sectors. This occurs when other entire industries build their core business models on the fundamental assumption that house prices will eternally rise. When the music stops, those peripheral industries face an existential crisis because their revenue model is completely shattered. Here's what this means for you. Understanding these three triggers helps you separate everyday market fluctuations from genuine economic red flags in your own community. Let's now look at who is getting caught in each of them right now. The granular foreclosure data shows exactly who is getting crushed by this shifting market, and it ties directly into that first trigger of over-leverage. Negative equity, which mechanically means you owe more on your mortgage principal than the house could sell for on the open market, has essentially doubled in a single year. According to the foreclosure data hubs, as of early 2026, the national figure sits at roughly 1.2 million homes. That's about 2.1% of all active mortgages. And critically, for the sake of balance, that 2.1% is hovering right near the historical average. It is nowhere near the disastrous levels we saw following 2008. On a macro national level, the system is highly stable, but on a micro level, that pain isn't spread evenly. It's hyper-concentrated in specific neighborhoods and specific types of loans. Specifically, it's hitting the 2022 through 2024 buyers who use low down payment, government-backed FHA loans. These loans are designed to get lower income and first-time buyers into homes by letting them put down as little as 3.5%. But mechanically, that means they start with almost zero equity cushion. And because of how loan amortization works, for the first few years, your monthly payments are almost entirely paying off interest, not the principal. So the loan balance isn't shrinking. Meanwhile, they bought at the absolute peak of the market. Even a mild 5% price correction wipes out their equity and leaves them underwater. The specific numbers from the foreclosure data hubs are striking. In Cape Coral, Florida, where we opened the show, roughly 70% of the 2023 and 2024 vintage FHA loans are currently underwater. In Austin, Texas, about 65% of the 2022 FHA loans are underwater. And it isn't just the stubborn mortgage principal squeezing them. They're being crushed by surging carrying costs. In Florida, for example, reported figures put the average home insurance premium at around $8,292 a year. That is roughly 3 times the national average. Property taxes have also surged based on those peak pandemic municipal assessments. So these buyers are completely trapped. They can't sell because they'd have to bring a massive check to the closing table just to pay off the bank. They can't refinance to a lower rate because they don't have the required equity to qualify. A temporary job loss, a medical bill, or a divorce used to be solvable by selling the house or tapping into equity. Now, those traditional escape hatches are welded shut, leading to unavoidable defaults and foreclosures. The painful irony is that the low down payment structure, the very feature designed to help first-time buyers into homeownership, is exactly what left them with zero cushion when the market shifted. Here's what this means for you. Buying a home at the peak with minimal equity leaves you zero breathing room if life throws you a curveball. If you're evaluating a purchase right now, The down payment isn't just about qualifying for the loan, it's your insulation against everything the market can do to you. Now, let me tell you about a completely underappreciated connection I don't think anyone in real estate media is talking about: elder care. It ties directly into the third trigger industries that depend on endless price growth. The demographic data is striking. By 2029, projections indicate there will be around 14.4 million middle-income seniors in the US. However, those same projections indicate that roughly 54% of them will not have sufficient financial resources from their savings, pensions, or Social Security to pay for assisted living. And to put that in context, assisted living currently averages around $62,000 a year, according to industry data. That figure jumps significantly higher for memory care or constant medical supervision. So mechanically, how has the industry survived if the majority of the people who need the service can't afford it from their monthly income? The entire industry has fundamentally relied on seniors harvesting massive home equity to fund their private pay care. A senior sells the suburban house they bought in 1985 for a tax-free windfall. And that huge chunk of liquid equity is what pays for their facility in the final years of their life. At the exact same time, real estate investment trusts, REITs, and private equity firms have aggressively bought up the physical buildings of these care facilities. Let me walk you through the mechanics of the arrangement because it's crucial. A REIT buys the actual brick and mortar building and then leases the operations back to healthcare providers using something called a triple net lease. In a triple net lease, the care provider, the people actually hiring the nurses and running the facility, has to pay the rent, the property taxes, the building insurance, and all the maintenance costs. The REIT does effectively nothing but collect the check. Zero operational risk. This allows the REITs to squeeze significant profits out of the arrangement. For example, Care Trust, a major REIT operating in this space, recently reported profit margins characterized around 67%. The actual care providers on the ground are often struggling to maintain decent staffing levels and basic quality of care because so much of their revenue is going toward paying that rent. So if home equity stagnates or falls across the broader residential housing market, this highly leveraged, equity-dependent model fractures instantly. If seniors can no longer sell their homes for massive premiums, they can't afford to pay the private pay rates to the care providers. If the care providers can't collect those rates, they can't afford to pay their massive lease obligations to the REITs. The entire structural ecosystem of aging in the US relies on the unspoken assumption that residential home prices will endlessly rise to fund end-of-life care. Here's what this means for you. Your parents' long-term care plans might be far more vulnerable to real estate swings than you ever realized. The entire financial ecosystem of aging in this country is quietly tethered to the housing market. Now, let's shift from the specific losers to how this feels for the broader public. Let's talk about the wealth effect. For most middle-class households, the house is the wealth. It represents the vast bulk of their net worth. So when the Zestimate on their favorite real estate app drops 15%, it creates a visceral psychological reaction. It feels like someone reached into their bank account and set a pile of cash on fire, even if they weren't planning to sell for another 20 years. That reaction has real macroeconomic impact. When people feel poorer because their home equity drops on paper, widespread consumer pessimism sets in. They cancel the kitchen remodel, skip the summer vacation, hold off on a new car, stop eating out at local restaurants, which hits the local economy immediately. This is exactly why the real estate industry groups endlessly argue that allowing house prices to fall will inevitably cause a massive recession. But is that actually true? To answer that, we can look at the ultimate macroeconomic counterweight, China. For a very long time, China's property market was the single largest asset class in the entire world. It was the absolute primary vehicle for household wealth, far more than the stock market is in the US. But following authorities' crackdown on developer borrowing a strict financing regulation known as the Three Red Lines policy, their housing market essentially froze. Prices fell consistently for roughly 36 straight months. Massive multi-billion-dollar developers went bankrupt, and countless high-rise projects were left completely unfinished. By all the traditional rules of the wealth effect, a 36-month deflation of a nation's primary wealth vehicle should have vaporized their entire consumer economy. It should have, but it didn't. How did they survive? Aggressive state management of the fallout. It was undeniably painful for individual investors and caused major domestic friction. But the broader Chinese economy kept going. Mechanically, state owned banks were directed to absorb some of the bad debt without freezing consumer credit. And more importantly, the state forcefully redirected the flow of national capital. Instead of banks lending endlessly to property developers for speculative high rises, capital got pushed into high end manufacturing, electric vehicles, and green energy infrastructure. They pivoted their economic engine away from real estate speculation and toward productive exports. What that proves empirically is that a major global economy can survive the severe deflation of its largest asset class if the capital is redirected effectively. Housing does not have to be an ever inflating balloon for a country to function. Here's what this means for you. A housing downturn might make people feel poorer on paper, but it doesn't automatically equal a broader economic recession. It just means the economy has to rely on actual productive growth and innovation rather than speculative asset inflation. So let me pull all of this together. Mechanically speaking, cheaper shelter across the board is a fundamentally good thing for a functioning society. It frees up massive amounts of capital. It allows younger generations to build lives and start families. It corrects deep systemic market imbalances. However, we have to acknowledge that good on average is definitely not good for everyone. That's the painful reality of unwinding a 2 decade subsidy. We are transitioning from a system that prioritized protecting asset prices above all else to one that might finally prioritize housing as a basic utility, a place to actually live. But that structural transition inevitably catches innocent people in the gears. The recent buyer who did exactly what society told them to do is now trapped underwater through no fault of their own. And the massive eldercare industry, which built its entire highly leveraged foundation on the assumption of endless equity harvesting, is facing a severe reality check. It's like a tightrope walker realizing halfway through the fall that the net they trusted was actually strangling them the whole time and they might just know how to land on their feet. It hurts to hit the ground, but they aren't dead. I want to leave you with one final thought worth genuinely sitting with, something we didn't fully get to unpack today. Local city governments rely heavily on property taxes to fund the local schools, fix the potholes, and pay for the fire department. So, what happens to the quality of your everyday civic life when the assessed values of all the homes in your city suddenly drop by 20%? That is a whole other massive issue, and it's the next domino nobody is talking about. Thanks for going down this one with me. I'll see you on the next one.